A big slowdown in manufacturing, a big bet on GameStop, and some big technical errors over at the NYSE. Live from Studio One here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Sonali Basak. We are kicking you off to the closing bell here in the United States, 1 hour away. Let's get you a check on markets. We are off the session lows for the S&P 500, but still lower on the day by 0.2%. The NASDAQ 100 as well was up earlier in the day to start the day, now down about 0.1% into the close. And you have a bid in the bond market. Don't forget, we have the 2-year standing at about 481 on the day, more than 5 basis points lower after that big ISM report. And of course, we also have crude right now at the lowest levels since February, 3.7% down on the day, Romaine, if you can believe it, after indications that OPEC has held output steady.
Yeah, that big market catalyst today really was that ISM report. So let's go back to that. What it showed was that U.S. factory activity is shrinking, output coming close to stagnating, and a backlog of orders falling the most in a couple of years. You saw yields on benchmark treasuries down 10 basis points at one point, the third biggest drop on a daily basis so far this year. And that actually sparked a modest rally in gold, a minor rally in the VIX, and all that is putting downward pressure right now on equities. However, one bright spot out there is GameStop and its meme stock brethren. Keith Gill's first post on Reddit in about 3 years showing he's still all in on the stock, holding a stake that would make him one of the company's 5 biggest investors. That was enough to push the shares higher at the open by 74%, though it has pared some of those gains as we get closer to those closing bells. The newfound enthusiasm, though, for meme stocks not shared by Morgan Stanley strategist Mike Wilson, who in his weekly investor communique warned about chasing lower quality equities. His argument, it centers around interest rates as stock-bond correlations slide further into negative territory ahead of what's going to be a busy couple of weeks, Sonali, for central banks and monetary policy.
We have a lot ahead for central banks ahead, starting with the ECB this week, as well as the Fed next week, and then the Bank of Japan. And let's talk about the divergence we're starting to see in central banking expectations. As early as January, you saw traders really in sync here, expecting both the ECB and the Fed to really start cutting more heavily this year. But you saw around March that divergence really start to begin, Romaine, and now you're taking a look at traders pricing in really nothing in terms of cuts coming from the Fed and expecting that first rate cut from the ECB this week alone. If you look at September pricing for the Fed, of course, we know that it's really still a flip of a coin here in terms of what swaps markets tell you about the Federal Reserve. But this week, all eyes on the ECB, and of course, big read through here, not only for the interest rate markets, bond markets, but currencies as well.
All right, kicking us off to the close right now is Sinead Colton Grant, Chief Investment Officer over at BNY Mellon Wealth Management, on what is setting up to be a busy couple of weeks up ahead here, particularly when it comes to monetary policy, Sinead. And we do have to now start talking about a potential divergence in monetary policy and divergence from the 2 biggest banks.
That's absolutely right, Romaine. Delighted to be here. So yes, the ECB kicks us off this week. We're expecting 25 basis points of rate cuts. And one of the reasons why they're first is because broadly, the Eurozone has not been as resilient. We had almost a technical recession in Germany, which was saved by a data revision, so didn't quite get to the technical recession. But look, it's been a softer economy. We think they go this week. The comments are going to be really interesting. But we think they could, in fact, do up to 4 rate cuts this year for a total of 100 basis points of cuts. And in contrast, the Fed, we don't expect anything from them next week. But what will be fascinating is the update to the statement of the summary economic projections.
Well, that's what I'm curious about, too, because since those last projections, the data points have been a little bit different. I mean, we've obviously gotten some encouraging news on the inflation front, but at the same time, we've also got some somewhat discouraging news about economic activity, the idea that we may be slowing down and slowing down in a big way.
Well, some slowing is good news, exactly what the Fed wants. But let's not forget that the last CPI reading was at 3.4%, so that's still higher than is comfortable. We've also got a very resilient consumer. And even while the labor market has slowed somewhat, unemployment is still below 4%. Now, we get the payrolls data and an updated unemployment rate on Friday, so all eyes on that. But really, I think we're starting to see some slowing, which is exactly what the Fed wants. but it's not very rapid slowing. It is moderate, and so we expect there's only one rate cut this year, and that's probably in December.
When we think about the rate environment here and globally, we have a lot of volatility that investors are really baking into different asset classes. You work with a lot of high net worth individuals, family offices, of course. We see in the family office world, some of the biggest trades are coming from that space. Are they looking more now to public markets and riding through the volatility? Or are they trying to find shelter in private markets to get away from that whipsawing?
You know, and this is what's fascinating, Shonali, because we have just launched our Family Office Investment Insight, which is a survey of almost 200 family offices around the globe. They have almost a third of their assets in private markets, between private equity, whether it's venture, growth equity, and private credit. So they're actually looking to do more in that space. Across the next 12 months, they expect they're going to do more direct investing, whether that's direct deals themselves, co-investments, and probably more than 6 of them. So they're finding private markets much more appealing. Now, that's not to say they don't focus on public. It is the second highest allocation that they have. And even at today's levels, they're viewing those as attractive.
Now, when you think about some of the riskier parts of those markets, you say private equity, for example, venture capital, there has been a significant mismatch here in terms of what valuations have jumped back in big public markets, those big tech stocks, for example, and what you've seen in, for example, venture. Do you find them buying the dip?
Well, so the interesting thing that we see is that when you've had a period of, let's call it recalibration, as we've seen in the venture space over the last 18 months or so, when you get to a period like today, that actually represents much better value, it's much more attractive, and it also links into the AI theme. So that's something else that we heard very, very strongly, that almost 80% of our family offices that were surveyed viewed AI as the biggest investment theme over the next 5 years. When they look at where they're going to access that, very often it's through the venture space, it's through the private equity space. So I think you really have the two themes intersecting there.
What's the sort of biggest risk that you found among these family offices, the biggest risk that they have their eye on?
Well, there were two, and they're almost tied. The first, unsurprisingly, is geopolitics, where we have the events in Ukraine, in the Middle East. We've got tensions in other parts of the globe, too. So geopolitics very much top of mind. And the second is inflation. So the fear of a second leg up in inflation, which kind of brings...
People are still worried about that.
They
Even high
are.
net worth folks?
They are, because inflation, historically, when it becomes entrenched, can be very difficult to eradicate. It's one of the reasons why we think that the Fed is going to be much slower to act, because they want to make sure the economy has taken this medicine so far. They don't want to act too early.
All right, Sinead, this is great stuff here. The new Global Family Office report over at BNY Mellon Wealth Management. Sinead Colton Grant, of course, is the CIO over there as well. Helping us kick us off to the close here on this Monday afternoon, a Monday where we woke up to the return of meme stock media, with GameStop surging more than 70% at one point on the day, with the Reddit personality known as Deep Value Roaring Kitty, whatever you want to call him. He's back, and he's claiming he's holding on, Shonali.
And we've also woken up to Paramount and more M&A news. David Ellison's Skydance is said to be sweetening its offer for the giant media company, and Paramount shares have been higher on the day. We're going to look at what that deal means for shareholders. And as we head to the close, we're going to get some insights on today's trading from Nguyen, CIO of Equity Strategies at Research Affiliates. Don't go anywhere. A lot more coming up right here on The Close on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
We are seeing the labor market come into better balance.
That foundation for the economy is solid.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is not a labor market that's slowing down or grinding to a halt.
That's why everyone is looking at wages.
Payrolls report, 8:30 Eastern Time.
The May Jobs Report, Friday on Bloomberg.
The GameStop frenzy, it's back. Shares are surging after trader Keith Gill, known as Roaring Kitty, posted what appeared to be a $116 million position in the company. And for more, let's bring in Bloomberg's Bailey Lipschultz. If you do the math on what he bought, the options and the stock itself, he could get to a nearly $500 million fortune. What would it take Keith Gill to get to that fortune?
Yes, and so that is using the peak price not only on an intraday basis for the stock, but also for those call options. So when you kind of crunch the numbers, that's about where he's at. So $485 million on paper was the peak today. If he were to exercise the number of call options that he has, convert those into stock, so not only would he need $240 million to do so, but at that point he would then own about 17 million shares, which that would then, on paper, to your point, put him about $510 million paper fortune, knowing that GameStop could open anywhere tomorrow.
Well, the other point you made to me a little earlier, and I think it's worth kind of drilling down on more, is how much does Keith Gill show a resurgence of the meme stock mania, of the retail trader coming back into the markets? How much of it is just quants following the signal?
And I think that's the big question. We have 141 million shares trading today. So when you kind of extrapolate some of the data we've seen on Fidelity's platform, they're not really seeing buy orders markedly outpacing those to sell. So it does seem like while retail may be stepping in a touch more than they did maybe back in May, we're not seeing overwhelming buy orders like we saw back in 2021. So to get to 140 million shares traded, you have to kind of connect the dots and say quants, momentum traders, maybe just bored Wall Street traders, someone is flipping these stocks.
Well, but is the momentum there too? I mean, we were talking a lot in the newsroom about sort of the lack of short interest relative to the short interest that we saw a few years ago. So relatively speaking, it's lower. And then of course we had that interesting commentary by Andrew Left over at Citron saying he had closed out that short position back in May, but he has now re-entered a short position. Now, we don't know how big it is or what the contours of it is, but is this going to draw out the short sellers?
Probably not. I mean, when you look at the data, we've seen that short interest floating in the 20 to 25% range as it relates to the free float. So you're seeing either shorts covering and then new shorts lining up to bet against the stock, or short sellers realizing that, hey, maybe it's better to stay away. And you have to kind of use a ladder approach to it. That's something that Andrew Left and others who lost and got burned back in 2021 learned, is you can't just short the stock and assume fundamentals are going to win the day because the stock goes up a bunch, you lose money.
You do more than just cover the stock. You've been covering the actual fundamentals. Have the fundamentals actually improved from, say, 2020, 2021, when this stock really just took everyone's attention?
No, not really. And when you look at the underlying metrics they've been reporting, sales are at best flat. Yeah. And when you look at what Ryan Cohen's been trying to implement, when I talked to Wedbush's Michael Patcher, he kind of calls out, there hasn't been a strategy, there hasn't been a follow-through.
Because that's what I'm curious about. I mean, he didn't really explain a deep value, didn't really explain why he would re-enter this, or build up that position, I should say. So, I mean, that seems to be a big difference from the last time, because last time he was laying out a fundamental case as to why he was bullish on the stock.
He was also laying out the fundamental case that, hey, 140% short interest is something that at some point could blow up. And that's what happened in January. That was part of the issue when you saw the rally, kind of absent of the fact that we saw a number of individual investors flocking to Robinhood and Reddit to trade the stock. Right. When you have a short position or a short percentage of float well over 100%, it's kind of a ticking time bomb. To your point earlier, 22% is nowhere near that.
Hey,
level.
Bailey, if the stock is trading above $31 right now, I mean, what happens if they just turn around after market and then issue another stock issuance at this point?
There are a few steps that have to happen. So they would have to file for that at the market offering. That's what happened back in May. So it takes a day or few hours at least for that to kind of be able to be freely traded. But that's something we saw that happened back in May. GameStop moved relatively quickly to raise almost $1 billion on the back of that.
Yeah, it'll be interesting to see. Is there going to be a sequel to Dumb Money? Maybe we can just call it Smart Money.
Yeah.
Maybe like The Revenge of Ken Griffin or something like that.
Well, maybe like AQR and some of these wants.
Okay. All right, Bailey Lipschultz there. We won't go down that road. Bailey Lipschultz, a closer look at GameStop shares. Pairing some of its gains on the day. They were up, of course, more than 70% at one point. And, of course, in the pre-market, I mean, they had almost doubled, which seemed a little absurd.
Yeah, well, you know, there's a certain number of stocks, but back in 2021, you had retail traders on some days accounting for 25% of the market.
Yeah.
What Bailey is saying is we're not seeing anywhere near that right now. And, of course, a lot of these stocks that the retail traders had bought at that peak had lost a lot of value. So let's see how many have dry powder this time around to be engaging in the markets in this way.
We should point out some other meme stocks are getting a boost, though they have peeled back some of their gains, including Reddit itself, as well as Robinhood, now in the red, and AMC. When we come back after the break, we're going to take a closer look, though, at another big stock, and that is NVIDIA, the AI behemoth. really moving the market once again, but not every sector is reaping the benefits of the AI boom. An interesting conversation coming up in just a second with Gil Luria over at DA Davidson about why only a handful of software companies are selling meaningful AI products. That's coming up in a bit, right here on The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we're going to start it off today with Cava, the restaurant chain losing its overweight rating over at JP Morgan. A valuation call for the analyst as Cava's current stock price is, quote, too far above the analyst's $77 price target. He says the incremental recommendation right now is to hold or reduce positions and says he now prefers Chipotle in the fast casual space. Those shares taking a leg down by about 6%. Next up, Best Buy, a rare buy rating for the stock, a double upgraded Citi from sell for what the analyst calls positive multi-year opportunities. He sees upside potential to earnings as consumers opt for more updated electronics and as AI innovations drive demand. The demand rising today for Best Buy by about 3% here on the day. And finally, let's take a look at the AI king, NVIDIA, a price target getting raised to another street high, $1,500 over at Bank of America. This after CEO Jensen Huang stoked further excitement for those updated AI plans over the weekend. The analyst says he's bullish on semiconductors due to AI tailwinds and solid free cash flow. Investors remain bullish on the stock. NVIDIA shares up another 4%. Those are some of our top calls, but we do want to stay in the AI space because while chip makers and hardware stocks continue to reap the benefits from the AI boom, the software companies out there, or at least for right now, they seem to be getting left behind. As DA Davidson points out, only a small handful of software companies are actually selling meaningful AI-based products, even though they're all claiming to. Joining us right now to talk about his note is Gil Luria, Managing Director and Senior Software Analyst at DA Davidson. And Gil, I feel like we kind of got a little bit of a taste of this last week when some of the software companies reported, including Salesforce and a couple others. And we did not necessarily see that sort of groundswell of AI speak in the same way that we see it when these chip makers report. What's the disconnect here?
Well, here's the picture that's starting to become clear. Over this last year, enterprise companies, the software companies' customers have been rushing to have AI solutions. So they go to their software companies, their Workday, their Salesforce, their UiPath, and they tell them, we need AI solutions. So those companies turn around to Microsoft Azure and Amazon AWS and say, we need GPU capacity so we can develop some AI solution so we can sell that to our customers so our customers can be happy. Then Microsoft and Amazon turn around to NVIDIA and say, give me as many GPUs as you can because I can turn around and rent them at these exorbitant rates. That's what's been happening so far. What that means is these enterprise customers aren't buying any other software. It means that these software companies are so distracted with rushing AI products to market, they're not developing the new tools that can help them grow the business. And then they're turning around and spending too much money on GPU capacity. That's where we find the software landscape right now. And it's the AI is crowding out their usual spend, and that's why they're struggling this year.
What sort of breaks us out of that cycle, Gil? Is it going to be just some natural evolution that this cycle runs its course, or do you need sort of more of a catalyst to kind of jolt folks back to reality?
There's two ways this could play out. Either one, we get some really killer applications around AI that get broadly adopted. The rule of thumb here is that to justify the data center investment we've made, Microsoft, Amazon, Google need to have an incremental $60 billion of revenue, which means their customers in turn have to have more than $100 billion of incremental annual revenue to justify this. If we get that, this AI cycle will continue. Otherwise, we're going to have some disillusionment by these enterprise customers. They're going to say, hey, we have an AI strategy. We looked at what you can do. It's not much yet. We're going to wait to see for these tools to mature. We'll come back to them in a year or two and buy them. And then we're going to come back to reality. We'll continue to buy software as we have. The AI cycle will turn into more of a cautious cycle. And we will get back to normal for these software companies.
Right.
They'll reaccelerate growth as they offer the solutions that they've always offered.
Gil, only 20 of 42 companies in the companies your team analyzes are at buy ratings right now, I believe. What would it take to bring some of those neutrals into even sell territory, given the valuation surges we've seen lately?
Well, if for the software companies to become sells, we'd have to find some new force that's taking business away from them. That hasn't happened. What's more likely is, as everybody gets their head around what's actually happening in AI, what's available now, they'll go back to normal spending and software companies' revenue will accelerate, and then there'll be more buys. That'll happen likely as we come towards the end of this year and into next year. In the meantime, there are a few places to hide. I mentioned two of them, Amazon and Microsoft. They're in great shape. They're the only ones that are actually selling recurring AI services. There's other niches, we like JFrog, FROG. Otherwise, you can look to software companies that sell to customers that are not drunk with AI. So for instance, Procore sells to general contractors. Those are not entities that are chasing AI right now. So they're continuing to buy Procore software. Or you can look for companies that are growing well and are now trading at a reasonable multiple of earnings and cash flow. We like Adobe. Adobe's trading at the low 20s in spite of the fact their growth is still double digit. And they're not going to be replaced anytime soon. So those are the kinds of places we're going to hide until we see an acceleration in enterprise spending when those enterprises get over their AI.
Just about a minute here, Gil. I'm really curious about which companies in your universe are more vulnerable to upgrades then, if you think that there is a moment at which they can be doing better later this year or even sooner.
So I would be cautious on the hardware side, because if the second scenario plays out and enterprises start wrapping their head around the reality that AI isn't ready for prime time yet, that's going to go upstream through the hyperscalers who are going to slow down their capex into next year. And I don't think anybody's anticipating that. If all these hardware companies that have been building up data centers don't have growth next year, that's where the risk is.
Gil Luria over at DA Davidson, take a look at his research, a lot about where AI is going in the world of software.
Yeah, and and we talk about this idea of like who really is going to benefit. Like it's easy to pick out an NVIDIA, even a Microsoft is easy, but everyone wants to know where else does this expand to. And if you didn't see that in the earnings, and it's not just a revenue story, it's really, as he pointed out, it's also a margin story that's just not there.
Valuations have flown so fast so far, you have to wonder, people are looking for new places to go.
All right, another big story that we're keeping an eye on is the saga involving Paramount and Skydance. A conversation coming up in a bit. This is The Close on Bloomberg. Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Sonali Basak. And Romaine, I have no idea what to say about a market where you're down on the day for the S&P 500, but GameStop is soaring.
I know. I guess that's the only bright spot out there. Here, you thought there would have been a little bit more momentum, particularly with some of the tech stocks after last week. I know we had a few disappointments here, but the crowd in that trade, it just seems like it's just, I don't know, I guess maybe people are just over it. They've made their profits, and maybe everyone did sell in May and go away. Who knows?
Yeah, maybe everyone's gone and the quants are trading for them. The computers are in full swing, and they are following the retail trader.
Well, one day, Sonali, it will only be computer trading, and maybe it'll only be computers anchoring as well. We should talk about some of the individual movers, because the biggest gainer right now in the S&P 500, that's actually Paramount. Those shares up about 10% here on the day. This after we're learning that film producer David Ellison and his Skydance is said to be offering $23 a share to investors in Paramount. Now, this is only for the voting stock, and it's kind of complicated, but this is a part of his plan to sort of win over those investors while at the same time buying out the Redstone family's voting shares, which holds most of the voting stock in Paramount. Joining us right now to talk a little bit more about this is Barton Crockett, Senior Research Analyst over at Rosenblatt Securities. And, Barton, there's been a lot of speculation here about which deal would win out. This one actually seems a little bit more plausible. I have no idea what's in Sherry Redstone's head right now, whether heading into tomorrow's annual meeting, she'll actually bite on this. But what do you make of this offer based on what we heard from the previous offers?
Look, I mean, it's hard to really kind of go too deep on this because we're not in the room where it's happening, right? But certainly this checks a box of an offer that would, cash out Sherry, which seems to be what's in play. And it seems to be an offer that offers some type of advantage to current kind of non-voting shareholders, which I think is important. And it gives them some flexibility. It's not just a cash out. But it seems to be, if you want to keep some of your money in the game as a wager that this thing works out at the end of the day, that you get some flexibility here that you don't have in the other offers. And, I do think that the shareholders in Paramount today, while a lot of people are skeptical, the shareholders are probably more optimistic. And so I think the idea of having the ability to mitigate your risk and get some money off the table today and keep something in there on the chance that it works out better longer term, I can understand why the special committee might have approved that as has been reported.
And it's interesting, at least based on the Bloomberg reporting, this is like a 25, 26% premium, and it's only for less than half of the shares out there. But that means that the premium ascribed to this company itself as a whole is still pretty significant. And I'm wondering, when you look at the current valuation of the company, what type of premium will be put on top of that from a financial perspective and from an analyst perspective? Does that make sense to you?
Well, look, I would push back. If I do the math, I'd say on a consolidated basis that you're about, 5% above where the voting shares are trading and about 17% above where the non-voting shares are trading. And so the market cap kind of premium that you're at today versus where the stock is trading, which has obviously been impacted by this news, is about 16%. So there's a little bit of, arbitrage uncertainty. This hasn't been announced, but it doesn't seem crazy where the stock is trading now versus the report that this seems to basically be the inside track. I think what this does say, though, is, if this is the price that we're dealing with, there's not a lot of value being ascribed to the cash flow engine of Paramount, which is their TV networks. There's been reports that in the other group, Apollo, Sony was kind of valued the studio at $11 billion, the Paramount studio. If you take that as kind of where the Skydance group is, and you ascribe no value to streaming, you're only looking at kind of a 3x kind of cash flow multiple for the TV networks, which is a number that I don't think anybody would have really thought was possible, even just a few months ago. That speaks to the secular and the sentiment pressure on TV networks.
So does that mean that you think that there's still money being left on the table here, given how this deal has evolved over the last couple of months, and is what the current offer looking like? Could that be enough to ward off any shareholder lawsuits?
Well, look, I think that the idea that you're implying a very low multiple on the TV network cash flow, is what would be potentially appealing to those that, might want to leave some shares in this company, as a flyer that maybe it's worth more, down the pike. I think that, the trading multiples for the comparables are, at least a couple of turns above that. And so, you could understand why, there'd be an offer that would kind of split the difference, let those cash out who are truly scared and frustrated, and let those who want to keep some money in the game continue to do that. So it makes some sense.
Barton, if you wanted to keep some money in the game here and keep some stake in the future company being discussed, is David Ellison's story credible here in terms of what he could make this company be in the future? Well,
I haven't heard it from him and from, the company. So, I really have to risk that. I would say that what I am hearing sounds, a little bit kind of aggressive. The type of cash flow growth that they're seeing in the Skydance studio sounds aggressive to me. The opportunity to, really kind of stabilize the TV network business, that's going to be a tough road to hoe given all the secular pressures. That said, It certainly does make sense to have a change in leadership. And I'm thinking about control shareholder leadership, with the Redstone kind of regime under Sherry. I think that stock is clearly breathing a sigh of relief that there could be someone new kind of owning it and ultimately calling the shots. So maybe a different coach gives you a better outcome.
Do you think that kind of keeping this company together, at least as we know it to be right now, that is the smarter way to go about this?
No, I mean, I truly think that this company, like the other entertainment conglomerates, should split up. I think the TV network business is a melting ice cube. I argued, years ago when, Sumner Redstone, first passed away, that Sherry should have sold it. And if she'd have followed the advice then, the Redstone family would be a lot better off today. And so would Paramount shareholders. I think that, I think there are value-based kind of vulture capitalists, I would call them, that could milk the cash flow on TV. And I think there's a huge premium on the content that you're producing in the studio. But that could be more valuable in the hands of internet companies that are really, I think, able to leverage content better than TV companies can today.
All right, Barton, great stuff. Always appreciate talking to you. Barton Crockett over at Rosenblatt Securities and neutral on Paramount. The shares up about 9% here on the day, as it looks like at least investors seem to be speculating that maybe this is the end of the saga, that maybe this will be good enough for Sherry Redstone to finally sort of cash in her chips.
Do you believe it's the end?
No, I don't. But I'm trying to hold out hope here. Look, they got a big meeting tomorrow, so this is going to be on the table. And this puts a lot more pressure on her, right? The idea that you sweeten the offer for the non-voting holders who are going to be like, oh, yeah, we'll take that 23 bucks a share, and that puts a lot of pressure on her. But of course, she has a complete power right now. Her family has complete power right now. I mean, there's nothing these outside shareholders can do without her on board.
And as far as the outside shareholders go, say if you had another Apollo-Sony deal on the table, there is still regulatory approval. And there is a sense here that with a foreign buyer, perhaps that would be more difficult than if you keep it at home here. And so certainty of a deal approval is something shareholders will be thinking about as they go into this deal.
Well, that's a good point, because it kind of makes sense from a regulatory perspective, right? The Skydance deal would probably get through a least easier than a deal involving Sony, even a deal involving somebody like Byron Allen, who already has a lot of media properties. So there would be a lot of scrutiny with that. At least with Ellison coming in, he's a little bit fresher to a certain extent. Whether that's good or bad remains to be seen. What is bad, though, is I don't know what happened earlier this morning over at the NYSE. An apparent glitch over at the operator of the New York Stock Exchange, triggering volatility trading halts for dozens of companies. We're going to have more on the stocks affected. That's coming up next on The Close on Bloomberg. All right, for about an hour and 20 minutes this morning, the New York Stock Exchange had some technical issues. They're now investigating that after a glitch triggered trading halts in a number of stocks. Joining us now to recap the company's impact and really what happened is Bloomberg's Abigail Doolittle. And Abigail, let's get right to exactly sort of what happened. We're basically talking about these sort of limit up, limit down sort of measures that determine when a stock gets halted, right? At some point, these limit up, limit down indicators triggered erroneously.
Yes, I mean, there were technical issues, and where I would also like to start is to say that NYSE said that all of the issues have been fixed. So to your point, they started around 9:45, and then it was fixed a little bit after 11 o'clock. I think it's fair to call these flash crashes because, I mean, you had Berkshire Hathaway A shares down 99.9%. You had NewScale going from being a $10 stock to being a 13-cent stock, but there were odd trades in at least two stocks. What's of real interest to me, and so NYSE is saying that behind this technical issue, industry-wide price bands published by the Consolidated Tape Association Securities information processor. So they're clearly trying to disperse some of their responsibility. In terms of the trades getting matched up and such, that's not really my wheelhouse. But what I can say is if you own Berkshire at, say, 940 and it was a greater than $6,000 stock, and if you looked at your account at 947, it would have been a $185 stock. Now, to the best of my ability to know, based on my street resources and sources, that trade would be busted. However, if you put in a market order during that hour and let's call it a quarter while the stock was not trading, and then the stock opened back at the level it had been at, and then reopened. Once it reopened, it went up 18%. If your market order went up at 18% and then quickly the stock is back to where it started, you might be out 18%. I don't know that you would have recourse to bust that because you had a market order out there without a limit. I don't know if that's true. And that happened on NewScale, too. I mean, a $10 stock, 13 cents.
Abigail, what about the issues that we've seen over the last week?
Yes.
There have been a number of issues.
Yes.
Some people believe it's because of T+1. My understanding about this issue is we don't know that that's why this happened per se, but how much confusion is it causing among traders?
So it seems like there is a lot going on right now. So T+1 is a little bit different. This is front house pricing, that is back house settlement. So it seems less likely that it is related. But we also had the indexes freezing last Thursday, the S&P 500 and the Dow for maybe an hour and a half. And that was my first thought when I saw that. I was like, and it wasn't related, but you have all these glitches. So it's hard to not associate it with T+1. And then you have this mania with these meme stocks. So we have a lot of interesting stuff going on right now for sure.
All right, Abigail, do a little closer look here. Not really a stock of the hour, but really the NYSE running into a little bit of trouble this morning. Several stocks affected. We're told by the NYSE that those issues have been fixed. There is some breaking news crossing the wire. Abigail was just mentioning the meme stocks. This on GameStop. The Wall Street Journal, Shanali, is reporting that E-Trade is considering kicking Keith Gill off of the platform. According to people familiar with the matter that the Wall Street Journal reporter spoke to, they're concerned about potential stock manipulation around his recent purchases of GameStop options. Now, we have no more details than that. We have not spoken to Keith Gill about this. All we have is that quick tweet or that Reddit post that he put up showing, at least based on him, that he's holding a lot of shares and he's built up a pretty big options position.
Yeah, and of course we know, for example, all we really have is that screenshot. And beyond that, we don't know how long he's held for, whether he decides to hold them for a long period of time, and it has driven other people into the stock. Now, coming up next, we're going to get back to markets with Nguyen, partner and CIO of equity strategies at Research Affiliates. She's going to talk us into the close. This is The Close on Bloomberg.
This is the countdown to the close. Romaine Bostic alongside Shanali Bassick. As we count you down to the closing bell, Shanali, just about 10 minutes to go. The NASDAQ trying to hold into the green, but everything else pretty much red across the screen.
Let's look at all that red because we are still red on the S&P 500 into the close. We are down more than 0.1%. And like you said, pretty much flat on NASDAQ. We have a bid in the bond market here after that ISM data this morning. 2-year yields around 481, a more than 5 basis point move lower. And crude at a 74 handle, flat there, 3.8% lower on the day, almost 3.9%. And that drag on the energy sector is actually what led the S&P much lower today, Romaine.
All right. Well, of course, the market today woke up this morning with a closer look at that ISM manufacturing data. Not good. But of course, that data really goes against the backdrop here of what's happening with interest rates as we head into a really busy couple of weeks for central banks worldwide. Nguyen joining us right now, partner and CIO of equity strategies over at Research Affiliates. And Nguyen, I want to talk about kind of the refocus on interest rates because I felt like a few months ago, everyone was saying, okay, the Fed doesn't matter as much anymore. We kind of know what they're going to do. Let's focus on earnings and corporate fundamentals. But we had a pretty big reminder, I think, with the last few economic data points that interest rates in the Fed are still the elephant in the room.
Absolutely. Interest rates in the Fed are still the elephant in the room, but I think what's been happening of late is that people have added a concern about growth to that. And so it's not just about is inflation under control, can the Fed lower rates, but if the Fed is lowering rates because we're going to go into a very deep recession, that's not great. So they're trying to get to this kind of Goldilocks situation, steering between the Scylla and Charybdis of growth and inflation. So far, it's been pretty good. But whether or not it can continue is something that's difficult to see.
And I always hate this idea of sort of where we are in the economic cycle, but I kind of have to ask you that because your view of the market is really going to be dependent right now on where you think we are in this economic cycle.
Well, I think that it's safe to say that in any given year, there's a 40% chance that you'll hit a recession, right? And right now, I would say that a soft landing is still on the table. I think the Fed's been absolutely right earlier this year not to become more restrictive, even in the face of higher inflation. And now we're seeing the other side of that. So, yes, it's true that the inflation data is not where we want it to be. It's true that the growth data has taken a turn south, but it's still not too late for the Fed to react to that appropriately.
So if you have concerns about growth, and if you have concerns here about the level of interest rates we're standing at right now, then do you play this market with more caution, or do you find places to really pick at the edges still, given where we stand?
So I definitely think that you can find places to pick at the edges still. I think that equities will actually see through higher rates as long as earnings remain decent. And so far, they've been pretty resilient. Slowing growth just basically means that there will be earnings in certain places and not other places. A great example is you look at something like, highly priced stocks. They're going to be very, very sensitive to whether or not they meet expectations, not just in terms of their earnings expectations, but forward guidance. A great example last week was Dell. They beat on a whole bunch of metrics. Their forward guidance was ho-hum, and the stock tanked, right? Partly because it's expensive. You look at a comparable stock like HP, very, very cheap. They beat on a bunch of their earnings and revenues. Their forward guidance was, again, sort of ho-hum, and that stock went up 15, 20%. So it's very, very dependent on, yes, you do have to have the earnings, but you also need to have an appropriate level of valuation.
Well, speaking of valuation, there's been a lot of questions this year about the breadth of the market, how much things can really start to broaden out. And if you think about the ability to broaden out even more, besides specific names, I mean, what are the trades? Romain was talking so much about this idea of momentum. Where can we start to see momentum?
I think that you're definitely seeing some broadening out in the last week or so. You're seeing small caps start to participate, some value names start to participate. I think that one of the things that you're seeing is the healthcare sector is a great sector. It got hit really hard earlier this year. You'll be able to pick up some pretty high quality names in that sector at pretty reasonable valuations. And it's also something that's resilient to the economic cycle, right? So if you're really worried about high interest rates, you're worried about growth, healthcare is an interesting place to be right now.
Anywhere else? I mean, we talk so much about sort of the potential safety of healthcare, obviously the promise of tech. Anywhere else that sort of strikes your fancy?
I would say that within tech, one of the things that we like the more reasonably valued names. I do think that even if you go into a recession, businesses will still need to invest. Mm-hmm. The coming wave of AI requires a lot of investment on the part of businesses.
Go ahead.
Yeah, no, I'm kind of curious here. We're talking so much about value and rational investing on a day where GameStop is soaring. And when you see this kind of euphoria enter the market again, what does that make you think?
I think GameStop is really very much of a small niche retail-y kind of trade. It's not necessarily a long-term investment thesis. And so at our firm, we just sort of see past that. It's not an institutional level type of opportunity that you can really capture.
Well, when we go back to those institutional level opportunities, it was interesting you were talking about the divergence between Dell's share performance and HP's share performance after that. And it just kind of in my head, I was just thinking about kind of, when pairs trades used to be a little bit more popular. And I wonder, are we kind of in that sweet spot now where now that you have real divergence in names, real divergences in sectors and industries, that you can sort of play that as an investor, as a long-term investor and a value investor?
Yeah, absolutely.
Yeah.
We definitely believe that you can. Mm-hmm. As a value investor, we think that the future looks very, very bright for the right types of value stocks, right? You don't want to get stuck in really, really cheap names that are just very low quality. But if you pick your spots correctly, I think that there's a lot of opportunity right now to be able to make those types of trades.
Yeah, and interesting you use that word. Mike Wilson also used that phrase in his latest weekly note here, not chasing after the low-quality names. Nguyen over at Research Affiliates helping us count you down to the close here with just about 3 minutes, Shally, until we get to those closing bells. And I was going through and I was looking at the big gainers on the day. And I mean, this is one of those days where it is kind of a lot of retail stocks. I mean, obviously GameStop is pretty much one of the biggest movers, but you have Paramount also moving higher here on the day. And then from there, it's a lot of kind of retail favorites, Spotify's and the MicroStrategies of the world on the day.
You have to wonder how much people want to put chips on the table today when you have such big data coming out later this week, ending with jobs on Friday, the Fed next week. And, to Quay's point here, I just want to point out something. I did a quick check here on the Russell 1000 growth versus value indexes. Growth has been up 13% this year, while you've only had less than 6% on value. Mm-hmm. Maybe it's the time for value to catch up. I don't know.
Well, we've seen that rotation. A lot of folks really trying to find it. It's hard, though, right? I mean, let's face it. Let's be honest. We went through an entire bull market where everyone basically decided that bottom-up fundamental analysis wasn't necessary.
Out the window.
I think a lot of people are having to sort of retrain themselves on, how to actually pick stocks other than just, turning on the TV and just, throwing a dart at the board. All right, we are moving closer to those closing bells. Our full market coverage of all the big movers on the day starts right now as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Sonali Basak. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast. We're joined by Scarlett Fu here in Bloomberg's TV Studio 1. Tim Senovic and Carol Masser in our radio booth as we welcome our audiences across all of our platforms here on this Monday afternoon. Carol, a mixed bag in the markets, but similar to what we saw on Friday, Carol, we had kind of stocks in the red all day, but as we got closer to those bells, bids started to come in.
Yeah, it's kind of interesting to see some buying on a day when we got some weak factory data. We're going to get a lot of weak data throughout the week. We did see, though, I think what's interesting is the fixed income side of things, the U.S. Treasury trade and yields really backing off in today's session.
Yeah, also saw oil move lower thanks to a surprise move from OPEC Plus. But Scarlett, I mean, we spent a lot of our program talking about what's going on with GameStop. That's a little different than last week.
Yeah, I really liked what Sonali Basak was asking our guest earlier, which is the return of meme stocks. I mean, what does that say about retail participation and whether this idea that the rally, may be nearing its peak or maybe has a lot more room to go with all this participation?
I love how much of a team we work like right now because, yes, we watch those retail traders. Bailey Lipschultz over at Bloomberg also makes the point here that there's so many quant signals out there, and some of this buying can be those professional robotic traders, frankly, the computers, rather than tons of retail traders alone.
GameStop, one of the big stories of the day. So too is Paramount. Those shares up about 7%. And so too were those glitches that we saw on the NYSE earlier today. We're now learning that the NYSE has decided to bust some of those trades, including the ones on Berkshire Hathaway. That basically means that if you got stopped out either on limit up or limit down, well, whatever losses you had in that, well, you're going to have to eat them. All right, we get the closing bells here in New York on this Monday afternoon. A bit of a turnaround from where we were just about an hour or so ago. The Dow Jones Industrial Average is still going to end the day in the red, though well off the lows of the day, down 115 points or about 0.3%. The S&P 500, though, flipping from red to green, is going to finish higher by about 6 points or 0.1%. Similar story for the NASDAQ Composite, up about 94 points or about 0.6%. And the Russell 2000 still holding in the red, though once again off the lows of the day, a loss on the day of 0.5%.
All right, as Romaine just laid out, those major equity averages, the S&P 500, though, even though it squeezed out a gain of about 6 points, nonetheless, most names, or majority of the names in the S&P 500 lower today, Scarlett, 333 names losing some ground, 169 to the upside, one unchanged.
Yeah, but the ones that are gaining are among the biggest companies. You look at the sector performances, and there's the pie, pretty mixed, as Carol was just telling us. But tech, which is the heaviest weighted sector, up 1%, led by NVIDIA, led by Micron, led by Oracle. Then you have healthcare services up about 0.7%, and communications services, the third best performer, gaining about 0.5%. Energy, the real laggards here, as all 22 members are down, falling in line with oil.
All right, let's get to some of the individual gainers. GameStop, I had to do it, up 75% at its highs today, finishing the day with a 21% gain. You know the story. We've all been covering it. The Reddit account that drove the meme stock mania back in 2021 appeared to be taking a $116 million position in the video game retailer. So there was a lot of activity, certainly on that one. Paramount also.
Did you see the news, though, that the Journal had just
Yeah, we just talked about this.
We just talked about it. That E-Trade, right, considering basically telling Keith Gill he can no longer use the platform. They're concerned about potential stock manipulation, according to those familiar. So, yeah, kind of following that one, and we'll see where it goes. Back to some of the gainers. Paramount, up about 7.5%. Skydance Media, this is the one led by David Ellison, Larry Ellison's son, planning to offer $23 a share to investors in Paramount's voting stock as a part of a plan to merge. I just feel like, will somebody just do a deal already? But nonetheless, Paramount gets to move a lot as the headlines continue to come out, up 7.5%. Autodesk, this is the number 4 gainer in the S&P 500, up about 4.5%, soaring after the company reassigned its CFO, a move aimed at resolving an internal accounting investigation that delayed filings for weeks. should point out no financial statements will be restated or adjusted following the results of that investigation by the company board's audit committee. And then just one more, I had to mention NVIDIA up another 5%, pretty much closing at its best levels of the session. This is among your top gainers in both the S&P and the NASDAQ. The CEO coming out, making some AI announcements in Taiwan. A lot of news, continues to all things NVIDIA. All right,
$11.50 a share right now. That was the close. Then we get a stock split, right, that goes into effect next week.
That's a really good point.
Yeah.
Yep. Still
10 for 1, right?
Yeah, I
10 for
hope
1.
so.
Yep.
That's what they told us.
Hey, Scarlett mentioned energy under pressure today. Chevron, my first decliner on the day today, down close to 3%. I did watch oil companies and shares of energy companies after the price of oil tumbled following OPEC Plus unexpectedly rolling out a plan to restore some production to the market this year. It adds to the bearish momentum that crude has been experiencing for months. We saw energy players move lower today, including shares of Chevron. Also, some M&A news in the waste management space. I'm watching shares of Waste Management, which did fall today on the news that the company has agreed to buy the medical waste disposal company Stericycle for about $5.8 billion in cash. Shares of Waste Management fell by 4.5%. It is one of the biggest acquisitions in the waste management sector, and Waste Management will now be the largest trash hauler, or continue to be the largest trash hauler in the U.S. Tractor Supply shares falling the most in more than a year. It was the S&P 500's worst performer on a percentage basis today, all because of a note from Loop Capital's Anthony Chukumba, who says that a widening price gap versus competitors and the stock's lofty valuation raised concern. Shares fell 6.2%. What happened is Loop Capital did this study, and they found that Tractor Supply is on average 8.5% more expensive compared with March, and that by itself is not concerning. But with the stock up 33% so far this year, and it's trading at a significant premium to historical levels, he's concerned that shares are becoming priced for near perfection. We did see shares fall by 6.2%.
Have you ever been in a Tractor Supply, Tim?
I have not been in a Tractor Supply, but do you remember a few years ago when this company was kind of like all the rage?
Yes,
because
I do. For some,
it was kind of during the pandemic.
Yeah.
Yeah.
People were tired of making bread, and they were just driving around tractors. Is that what was going on?
Gosh.
I've been to Tractor Supply
competitors. Carol, clearly. You're such a city slicker, Carol.
New York City.
Yeah, not like a salt of the earth Midwesterners.
I've actually driven a big Caterpillar tractor, so at their I guess their proving ground.
Proving ground, wow.
Something like
that.
Was on assignment?
Can you please post that video on Twitter?
I will.
Yes, thank you.
It was a lot of
Okay, guys, we're getting off the rails. We're going to talk about the bid in the bond market as well here. Though I did believe Tim was a tractor guy. I'm a little disappointed to hear it. In the bond market, we did have a bid where we didn't have one in the stock market. The two-year yield at 481. You saw that move even more pronounced at the further end of the curve. People really buying on to duration today. The 10-year yield under 440, 439, a 10 basis point move. Same goes for the 30-year yield. You saw a 10 basis point move. Listen, guys, although you did see some exuberance here in the bond market after that ISM data, you also have to understand that some of the parts of the yield curve have been more inverted today than they were on Friday, which has been really interesting given how many steepeners have been bought, Romain.
Yeah. All right. Well, this is, of course, going to be a potentially busy week when we start to get some key economic data toward the ends of the week. We get an ECB decision in the middle of the week. And I had tried earlier this morning to text Carol Massar about this, but she didn't respond to any of my texts.
You got to call her.
Yeah.
I mean, how am I supposed to coordinate the show?
No, actually, don't call me. First, you have to text me that you're going to call me.
I have to text you first that I'm going to call you?
There are apparently rules. Who knew that phone etiquette or phone texting etiquette has become a thing? But apparently, there are a lot of people who are like, don't call me. First, you have to text me that you're going to call me, and then you can call me. It's a thing.
Yeah. You guys might not be surprised to find this, according to the Wall Street Journal, which cited some polling from YouGov and some other sources, that it kind of depends on the generation. The younger folks, the Gen Z folks, do not like to call. They prefer texting.
Yeah, but I mean, texting just takes too long. The call is so much more direct.
Have you guys seen the voice memo thing that is huge in other countries now?
Yes.
People
voice
are sending
memo
WhatsApp.
is big, but it's not here. What do you mean?
They're huge in other countries. Like my friends who live in Europe are sending me memos on WhatsApp, like where they're talking to their phone.
That's what I was going to say.
Yeah.
So this is when did this pop up? Because I just started getting all these like a few months ago.
Yeah.
I was like, I
Big in
don't
Europe.
know what's happening.
But the question is, how many messages do you guys have in your Instagram, Facebook, Telegram, Signal accounts as well?
It's confidential.
Kind of crazy. Kind of crazy.
Well, yeah, the good thing is I haven't called anyone since 1995. But we get back to this other thing, too. There was another story that I was keeping my eyes on, guys, in all seriousness. And this actually had to do with Airbnb. And there's this step up that they've taken to sort of fight a lot of these sort of local laws that are really trying to clamp down on the sharing. And it sort of has a reminder, kind of reminiscent of what we saw with TikTok when they were facing the ban and they were just going straight to the people. Let me show you just how valuable we are and everything that we're doing to help folks out.
Yeah, it's interesting, right, to see these hosts basically forming advocacy groups, right, to kind of make their fight against some of the laws that are pushing back, certainly when it comes to kind of having Airbnbs, if you will, in their neighborhoods.
But it's being helped along by Airbnb. They're kind of providing them with the infrastructure and giving them tips.
Wait, what? No.
Yeah.
I'm just kidding.
Yeah, giving them a little bit professional guidance. How about that?
All right.
That's it?
I think that's
I was trying to figure out.
Speechless?
Can I call you guys without texting? Is it okay?
I'll always.
Yeah, I mean, you can always call.
Whether he'll pick up is another question.
This is Romaine. Wait. Oh, Nasser? No, I'm going to put it down. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We're done with Monday. Almost. We will see you again, same time, same place tomorrow.
All right, stick with us. A lot more coverage coming up here on Bloomberg Television. We're going to take a closer look at the results of that election over in Mexico. Mexico electing its first female president, a landslide victory, but she's got some big challenges ahead. We're going to talk about what it means for her, what it means for Mexico, and what it means for the peso. That's coming up next, right here on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. We did have a market that tried to open higher, tried to rally higher, but really lost a lot of steam in the middle of the day. A big part of the reason was that second line on the screen there. We got some ISM manufacturing data that sent a sell-off that we continue to see buying in the Treasury space. That sent yields on the 10-year down 10 basis points here on the day. We saw similar moves across the curve, and that really dampened a lot of the enthusiasm in the market. But as we got closer to those closing bells, we did see a bid come back in. That helped to flip both the NASDAQ and the S&P into the green here, only fractionally here on the day. But I think, Scarlett, some investors will take it.
Some investors will definitely take it. All right, let's take a look at some of the day's big movers. We're going to start with some M&A on this Monday. Waste Management is expanding to medical waste, buying Stericycle for $5.8 billion in cash. It's a 20% premium to Stericycle's last close. Meantime, Coherent up 23%, the most since May of 2020. Analysts praising the optoelectronic maker's announcement that it has hired or poached or named Jim Anderson as its new CEO. Anderson, by the way, was previously head of Lattice Semiconductor, which finished the day down about 15.5%. And that brings me to what I'm watching this hour. Is there a gender gap in AI? When it comes to the actual technology, you've got NVIDIA as the undisputed industry leader, with its founder Jensen Huang celebrated as a visionary. In second place, Advanced Micro Devices, whose CEO Lisa Su is more focused on execution and partial to sharing the spotlight with others. Meanwhile, in the workforce, Gen Z men are taking the lead over women in utilizing AI tools, which is why organizations like Girls with Impact are adding AI to their curriculum, equipping the next generation with the requisite skills. We will speak to that organization's founder later this hour.
All right, meanwhile, we want to turn back to that election out of Mexico. You're seeing Mexican assets down here on the day, including the peso, the election of Claudia Sheinbaum over the weekend, the first female president in the country's history, a landslide victory. And believe it or not, that's giving some investors some concern. The former Mexico City mayor capitalizing on the popularity of outgoing President AMLO and got very close to clinching a supermajority in Congress, obtaining 2/3 of the seats in the lower house and about 2/3 in the Senate. For more, we're joined by Bloomberg's Mexico Bureau Chief, Carolina Millan. All right, Carolina, let's talk about this. I don't think there was any expectation that she was going to lose this election, but the complexion of that victory, it's, I guess, potentially good for policy, but the reaction by investors seems to be a little bit of trepidation. Explain what's going on.
That's exactly right, Romaine. So, like you said, leading up to the election, the polls were very much indicating that Claudia Sheinbaum was going to be the winner of the election, that probably her party would get the simple majority in both chambers. But what's been a big surprise that's been rattling markets today is that we already know that her party has a supermajority in the lower house, and we're still waiting for final results. But it seems it's still quite close to call whether they will also get a supermajority in the Senate. And the reason why that's so important and why that's worrying investors so much is because having that 2/3 supermajority means that the party can virtually move ahead with basically any kind of reform they want. And the outgoing president has already put forward 20 constitutional reforms, and that includes some that are really worrying folks. That includes one that would involve electing Supreme Court justices by popular vote, getting rid of some autonomous agencies like the antitrust regulator and others. So there's a slew of reforms that could really erode the institutions. And that's why you're seeing such a reaction in the Mexican peso today.
Has the incoming president made any specific campaign promises on what kind of legislation she is looking to champion?
So that's a really interesting question because Claudia Sheinbaum really is winning this election as part of a continuity platform with López Obrador. We have to remember that in Mexico, presidents are not allowed to run for more than one term. But López Obrador is leaving his presidency with over 60% of approval ratings. And so what that means is that she's had the challenge during this campaign period to indicate to his voting base that she's not going to stray too much from what he's proposed. Remember, these constitutional proposals were made back in February. It's only been a couple of months, and he's already suggested that he would like to work with the incoming president on these. So, of course, in her initial speeches last night, she gave some remarks that pointed to continuing the general mission of lifting people out of poverty, keeping positive relations with the U.S., but she did not give any specific clues of what this might look like in the coming months.
Okay, so it's more of a general overall concern that's playing out in the markets right now. Carolina, thank you so much. Carolina Millan joining us from Mexico City. Now, we want to talk a little bit about the moves in financial markets on the back of this election results. You do have the Mexican market falling quite a bit today, down about 6% so far. And of course, you look at the Mexican peso, and it is the worst performing major currency right now. Worst one-day loss since June of 2020. Nguyen Thin is Brown Brothers Harriman Global Head of Currency Strategy. Of course, he did specialize in EM currencies for a long time. Nguyen, the concern here is that the ruling party, the Morena party, will lead to more intervention in the economy. They might take some anti-market steps. How much of this is specific and how much of this is kind of just a knee-jerk reaction?
Yeah, well, first of all, Scarlett Romina, thanks for having me. It's always a pleasure. As you know, markets tend to overreact. I think, as your previous guests mentioned, that it was pretty widely known that Sheinbaum would win, but the extent of the victories, the Morena victories in Congress, is really what shocked markets. Now, so we're having this, I think, is pretty much an overreaction. Yes, there are clearly risks. As your Mexico correspondent pointed out, there are some things on AMLO's wish list that are really a bit disturbing for markets. I would say two things. We've seen this sort of unfold in the past. We saw this happen in Brazil. First, when Lula was elected as a leftist, and he was pulled really into the center. I think AMLO also ran as a populist leftist. Has ruled a little bit from the left, but has certainly been dragged, I think, closer to the center than many expected. So I would expect Claudia Sheinbaum to remain near the center. And my belief is that if she tries to veer too far from the center, the markets would be very unforgiving. I think that's the second point I want to make is that politicians always come with huge wish lists, but when they meet the reality of the market reaction, it's a quite different story. So I'm a little bit more constructive. I think that the underlying fundamentals in Mexico are solid, if not unspectacular, but nothing as bad as a peso would sort of suggest.
Okay, so that's an explanation there in terms of why we're seeing such large moves. One thing we do know is that within currencies, the yen has been a cheap way for people to borrow, especially those in Japan, borrow yen to buy higher yielding currencies. Peso might have been one of those beneficiaries. How much is that exacerbating the moves today?
Yes, well, I think what we saw this week was really a primer in emerging markets political risk. I've seen this time and time again where I think markets get a little too complacent about the underlying political risks. I mentioned this because earlier, over the weekend, we had the South African election, last week, that we saw a surprise loss for the ANC. Because there's a risk they have to rule with coalition. The risk is that if they end up ruling with a populist leftist party such as the Economic Freedom Fighters, it would be very, very sort of taken very badly by the markets. Now, the flip side, if they go into a coalition with the Democratic Alliance, is much more market friendly. That would be, I think, a positive outlook for South Africa. But again, it's just a reminder that politics is so unpredictable in emerging markets. A lot of risk. I would say both South Africa and Mexico have sold off greatly. I would look to fade those moves. I think the underlying fundamentals, again, are solid, if not unspectacular. The carry trade is always a risky trade in a strong dollar environment. And so I think that's from time to time we'll get some reality checks.
Give us a sense here, though, about how much some of these EM currencies right now are tethered to some of the decisions being made in developing markets. We knew that we were going to have these sort of one-off election events, whether it's over in South Africa, over in Mexico, and of course we're still awaiting some results out of other elections, including in India here. When does it stop being about just what is going on inside those countries and more about the global dynamics that could, I guess, either aid or hinder the appreciation?
Romain, that's an excellent point. I would say, to me, the two underlying sort of the major themes that are really important for emerging markets going forward, besides sort of this idiosyncratic political risk, is really first is Fed policy. Fed monetary policy is really the driver for global markets right now, with a higher for longer Fed. It's very difficult for risk assets such as emerging markets. We'll know more after this week. It's a key data week with the ISM services, jobs report on Friday. We have FOMC meeting next Wednesday. But my expectation is the Fed will deliver hawkish hold. Markets are pricing in steady rates until November. That's very negative for emerging markets. The second major factor is China. I think markets have gotten very bulled up on China. They announced what I thought to be a very timid rescue plan for the housing sector several weeks ago. And we're seeing a bit of a reality check that this is not that easy to solve. We're seeing copper prices, iron ore prices sell off a bit in sort of response to this thing, the notion that, China's it's in a little tougher slog. So to me, those are the two overarching themes that sort of put a negative overlay on top of this political uncertainty.
We only have about a minute left here. Nguyen, I am curious. I mean, you mentioned the carry trade, and there's been a lot of talk right now about the relative stability that we have right now when it comes to the rate environment, which opens the door up for that currency trade. Are you anticipating, though, that we could see any sort of pickup in volatility sometime this year?
Absolutely. Anyone, I think, in the markets has been lulled into a sense of complacency. Volatility has these ebbs and flows, but I find that when volatility really goes down, it's like a coiled spring. At some point, it will sort of pop open again. To me, the carry trade works in sort of a weak dollar, very loose global liquidity environment and low volatility. And right now, there's so much monetary policy and economic divergences around the world, not just in emerging markets, but in developed markets. In fact, we're seeing a likely ECB and BOC cut this week. Again, a lot of divergences. I think traders, investors in the rates market are braced for much more volatility due to these widening divergences.
Yeah. All right. Good stuff. Nguyen, really appreciate your joining us today. Nguyen Thin of Brown Brothers Harriman on the latest moves in the currency market. Coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's big stories, including a 90-something-year-old who's found love once again. This is The Close on Bloomberg. It's time now for the top three, where we focus in on the people who are driving some of the day's most talked about stories. And first up is Andrew Left. The short seller was bearish on meme stocks in 2021. He's bearish again in 2024. He's placed a new short position on GameStop.
I was most intrigued by the fact that he made this announcement publicly, because remember, all the short sellers sort of went scrambling some years ago after, Gabe Plotkin and those folks kind of had their, handed to them. And there was this idea that you can't really do short selling in the traditional fashion, which is take a position, go out on TV, promote it, and then hope to reap a profit. But I don't know, maybe he feels like the dust has settled and now he can get
He did stop for a while, to his credit, and now he's come back again. I guess he can't resist shorting GameStop right now, given everything that's happened.
All right. Well, speaking of coming back again, I don't know how many times you've been married, Scarlet Fu, but Rupert Murdoch is, going to try it again for a fifth time. He's 93 years old, and he got married over the weekend to a 67-year-old bride, Elena Zakova. And look, I don't want to make too much light of this. Look, everyone's got a right to be happy, but I don't know, 93,
She's age appropriate.
Well, I mean, she's still 25.
I know, but she's 67. He's like the J-Lo of media moguls. He's a hopeless romantic who loves being in love.
Hopeless romantic?
Yes, that's Rupert Murdoch, a hopeless romantic who loves being in love. I will stick with that.
So what's next? He's going to hook up with Ben Affleck or something?
No, Ben Affleck is not that. That's the thing. All right, the last person I'm watching is Nigel Farage. He is the architect of Brexit, and he says he's now changed his mind. He now plans to run in the UK's general election on July 4th, and this will actually mark his eighth attempt to win a parliamentary seat. Hasn't been successful yet.
Yeah, when I saw this headline, I thought, yeah.
Good for you.
I thought, yeah. I mean, look, I have no idea what's in the mind of British voters. Maybe he has a chance here, but I don't know. Does he have a chance?
Well, he'll be a candidate for Reform UK in Clacton, which is a seaside town. It tends to tilt a little bit more hard right, which is fitting with what he brings to the table.
So maybe he does have enough support there to get there. And so
I mean, either way, he's going to make things complicated for the current prime minister for sure.
Okay, well, at least he's actually trying to get involved in the government instead of promoting Brexit and then running for the hills like here in the U.S.
Good point.
Anyway. Nigel Farage is back. So is Rupert Murdoch, and so is Andrew Leff. When we come back, we're going to take a look back in history, Scarlett. Do you remember War Games?
Oh, of course, yeah.
All right, well, we're going to take a look back on the anniversary of the release of that movie, a very prescient take on AI.
They knew back in the 80s.
This is Bloomberg. All right, let's take a look back on this day, June 3rd, 1983. MGM released the sci-fi thriller War Games. Made on a relatively modest budget of $12 million and starring a relatively unknown actor named Matthew Broderick, the movie proved a box office success and inadvertently provided pop culture with one of the earliest and more prescient depictions of the uses and pitfalls of artificial intelligence. Now, let's be clear. This movie was pure fiction, and for everything it got right about AI, it also got a lot wrong. The plot of War Games, it's pretty straightforward. The U.S. government wants to reduce the likelihood of human error leading to a nuclear war, so it assigns oversight of a nuclear response to a stoic supercomputer called Whopper, which is programmed with a multitude of warfare scenarios and a multitude of solutions. Now, Broderick's character, a teenage hacker and gamer, accidentally breaks into the Whopper system, believing it's just a sophisticated video game. His back-and-forth interaction with the computer eventually reveals the severity of what he's tapped into as his gameplay pushes the world to the brink of nuclear destruction. Now, it should be pointed out that Hollywood trends often reflect the social mood of the moment in time, and it was at that time in the 1980s when the proliferation of computers was seen as a threat to jobs, to national security, and to global stability. Think about some of the biggest Hollywood movies back then that involved technology-fueled apocalypse. Think Blade Runner in 1982, Terminator in 1984, Reanimator in 85, or RoboCop in 87. But it was War Games that really was one of the first to portray the concept of AI and cybersecurity in a way that the masses could comprehend. Enough so that then U.S. President Ronald Reagan convened several national security meetings to determine if the fictionalized account in War Games could indeed be a reality. Now, what's so compelling about this movie is that the real threat of Whopper wasn't that it was nefarious. To an extent, it was just the opposite. The computer wanted to do the right thing, but was incapable of counting for the nuances of the world. It was a classic encapsulation of what psychologist Abraham Maslow characterized as everything looking like a nail when your only tool is a hammer. And while a War Games type of nuclear brinkmanship remains more fantasy than reality even today, until computers and AI evolve enough to comprehend the multiple shades of gray in our human existence, the benefits of ceding human decision-making to computers and to technology might be much further out in the future than the potential threats themselves.
I think we're just going to have to challenge all of our computers and AI to games of tic-tac-toe, and then all our problems will be solved as they were solved in the movie War Games. Remain, uncertainty over AI's ability to comprehend human activity is one of the factors holding some workers back from fully unlocking its potential. Slack is out with its annual Workforce Index survey, and it finds that more than 2/3 of desk workers have never used AI at work, despite more jobs using AI tools for operations. The findings also unveiled a gender gap with how AI is used, with Gen Z men more likely to have used the tools than women. So joining us now to tell us more about these findings is Christina Janzer. She is Senior Vice President of Research and Analytics at Slack. Christina, we gave a few of the highlights from your survey from the index. Can you tell me what you were most surprised by from the findings?
It's great to be here. Yeah, so Slack launched our Workforce Index today, which is a survey that we sent to 10,000 desk workers worldwide. And I think the thing that's so exciting is that the AI hype is real and people are really experiencing incredible benefits such as productivity. But the interesting thing is that there are real blockers, right, where people are not able to reap the real amazing benefits that we're seeing from AI.
Right. Part of that, in your survey, you found that only 7% of desk workers consider AI completely trustworthy, and only 15% of desk workers strongly agree they have the education and training to use that technology effectively. So is the answer just more education, more training? Will that remove some of the discomfort and some of the hesitation?
Training is definitely really important. That's the number one thing that we're suggesting executives and leaders focus on, because people who are properly trained in AI are 19 times more likely to experience the productivity benefits. And the productivity benefits are one part of the story, but we're also seeing that AI improves the overall employee experience, which is really surprising and exciting.
Talk to us, Christina, though, about the communication of that, because I think we all talk about the benefits at a high level, but when you start to get down to the workers themselves, a lot of people still see it as a threat. They think, oh my gosh, this is just going to take my job. You're not going to need me in X many years here. What type of communication is needed, or more importantly, what type of communication is already happening based on the study that you did?
So we're actually seeing that nearly half of desk workers are excited about the idea that AI could potentially replace some of their tasks, because the reality is that people are spending up to a third of their time on what I would consider work of work. These are low-value, mundane, repetitive tasks. So you could imagine a world where AI helps augment and replace some of that work that you don't actually want to do.
So, like what?
So it could be things like, researching. It could be things like reporting in different systems. It could be all of the work that everyone has to do as part of their job, but takes away from the real creative and innovative work that only humans are able to do. And that's really the opportunity that AI presents us with.
So within the survey, you found that when it comes to adoption trends of AI, there are certain demographic breakdowns. And I mentioned how Gen Z is more likely to have experimented, and men within the Gen Z cohort are more likely to experiment. But also, one thing that's interesting is AI adoption is highest among workers of color. What kind of read do you have into that?
Yeah, so these trends are really interesting. And I think when you look at the data that tells us that 2 out of 3 people still haven't used AI at work, that tells us that we're very early on in this journey of adopting AI. And when we see that Gen Z men are using it more than Gen Z women, that people of color are using it more than white workers, this gives us a little bit of a map for leaders to figure out what's happening today and what do we need to do to course correct to make sure that the people who are using AI today are representative of our entire population. So what this tells me is that leaders need to step up and provide training and enablement to everyone so that everyone can participate in the benefits.
All right, well, it's a really fascinating study, Christina, and obviously one that's close to the hearts of a lot of folks, both in the workforce and those entering the workforce. Christina Janzer, Senior Vice President of Research and Analytics over at Slack. And speaking of folks entering the workforce here, our next guest really does try to support those folks. A lot of folks out there really aiming to disrupt and dismantle the gender discrepancies that female business leaders face. Joining us right now is Jennifer Openshaw. She's the founder and CEO of an organization called Girls with Impact. And joining her is one of the success stories of that program, Jayla Thomas, founder of Thomas Family Taste, a minority-owned hot sauce business. Welcome to both of you, Jayla and Jennifer. Great to have you here on the set.
Thanks for having us.
And I do want to kind of piggyback off what we were talking about with Christina, because, I mean, you really are trying to prepare young women to enter the workforce, and you're preparing them now at a time that's going to look a lot different from when you and Scarlett entered the workforce way back when here. Kind of explain sort of maybe how, is it more difficult now to do that or just different?
No, I think this next generation actually really wants it, and it's smart for America and companies to
dig deeper earlier and train them. 85% of employers say that new hires lack basic skills. It is fundamental, and we want a workforce that's leaning into the future, right? They're not stepping back from AI, but they're embracing it, and so we're actually incorporating it into our business academy because we want them to be ready. We know that if particularly low and moderate income young women don't get exposed to it, they run the risk of falling behind.
What's like the most important thing that you want to teach these young women?
Is foundational business readiness. So, there's lots of things in coding, general college prep, but the world is moving toward we need a workforce that's ready to step in and lead from day one. So we are teaching them, how does the business world operate? These young women like a Jayla are going through a mini MBA at 15, 16, 20 years old. They are bringing a business idea to life because it's their idea. It takes on a whole different level of, interest, but they're learning things that come straight out of Harvard Business School. And so they become much more capable. They're also getting access to a network and those things that, again, if you don't, grow up in rich families, you really run the risk of falling behind.
All right, so let's talk to one of the beneficiaries of the Girls with Impact program and bring in Jayla Thomas. Jayla, tell us a little bit about your journey, because you graduated from Howard University and you took part in the Girls with Impact program. What did you get out of it that you couldn't get in your undergraduate career and that resembled kind of a business school setting but wasn't an MBA program either?
Thank you for that question. So I guess I'll start with saying I joined the program years ago, many, many years ago, thinking that it was just going to be a great opportunity, a nice extracurricular, and it was also free of cost for my family, so I was excited. I did not know about the impact that it would have years and years and years to come. And so one question you have is, how did it differentiate things for me in college? But it helped me get to that point in college. And so what I'll say is for me, it was a differentiating factor in my applications and my supplements. I got 2 full rides. I was admitted to Babson on a full ride and Howard. And I just graduated Howard last month.
Congratulations.
It's exciting because now I have to look at my venture full time, and I'm really excited about it because I'm employing my family, I'm employing my grandmother, my whole family works with me. And then the one other thing that I'll touch on is just, yes, it helped me build a business, but besides the business aspect of it, it just helped me be a more well-rounded woman and career person. So I'm entering the workforce, but I feel a lot more confident. I feel like I can stand on the ground and I know what I'm talking about. I know about these business words that we talked about in school.
Talk to us about your business itself, Hot Sauce here. I guess A, why? And 2, what was like the biggest challenge in just getting it up and running?
So why? Because my grandmother is an immigrant from Trinidad and Tobago, so it's called Shirley Scarborough Spice. That's the name of the product, and Scarborough is from where she came. The biggest and hardest part was just getting started, but the great thing about Girls with Impact is that it provides mentorship consistently throughout the entire, literally till now, and I've finished it so long ago. So I'll say, like, being able to talk to people who know their stuff, know the business, know food, know all that, and get advice, ask questions, things that I didn't even think about, has been life-changing.
So Jennifer, let me come back to you for a moment here, because when it comes to training up the next generation, there's soft skills and there's hard skills. Talk about how Girls with Impact addresses both.
Well, what's interesting is that 85% of on-the-job success is the result of professional or soft skills, but yet 85% of training is hard skills, and those are important. And so we're addressing those. But when you look at why do women come in at 50-50 levels in our companies and drop out as we go up the ladder? And, new numbers just came out in the last couple of days about women in the C-suite. We've actually stepped back. There are lots of reasons. There's corporate culture. Melinda Gates is talking about the boy culture, but there's also confidence that starts early. So when these women are learning basic business skills and bringing an idea to life that could be a for-profit or a social venture, they are building their confidence. They are understanding how to connect the dots. They become more capable of presenting their ideas in the workforce. And basically, we're building those professional soft skills so that they're more able to be productive
on the job is really what we're getting at, right? And employers, again, they told us that one of the number one things that they're concerned about is, I want a ready workforce, and when they're in the environment, how do I make the most of her?
Yeah.
How do you sort of keep them in there? I mean, we talk a lot about one of the reasons why you have this gender wage gap and some of the other gaps are because women often have their careers disrupted by family and other obligations that don't always necessarily fall onto the shoulders of men.
That's a great way. You know, this generation, we've heard how purpose-driven they are. They are really purpose-driven. They have very clear priorities of the workplace. And so we're working closely with companies as well to make sure when we hand off our Girls with Impact graduates that you're doing what you need to do on the other side. A lot of work to be done, but a couple things there are this generation wants to be coached. They're very coachable. But yet, like the majority of women in corporate America are not confident asking for a mentor or a sponsor. That is pretty surprising, right? They want to be upskilled. Some of the largest employers in America told me that during COVID, they saw a sort of a fallback of the professional skills of their younger people. We're working with them to upskill. Yeah. And then the last thing is that they really want to feel valuable in the workplace. Yeah. So we're coaching companies a lot on those kinds of things.
Jayla, let me ask you to have the last word here. What's next for Thomas Family Taste? Where do you want to take it?
This year, I want to get us into a major retailer, any retailer. I'm just really excited about that next step. So.
Have you ever thought about mentoring someone?
100%, and that's exactly what I plan to do through Girls with Impact and just in my community overall, especially women of color and women, because I think it's time that we level out that playing field, and I think that's what Girls with Impact is trying to do.
Fantastic to have you both with us today. Jennifer Openshaw is founder of Girls with Impact, and Jayla Thomas, founder of Thomas Family Taste, a graduate of Girls with Impact. All right, let's take a look at how markets closed on the day. It was kind of a mixed day, and we did end up finishing in the green, although it was a little bit of a struggle to get to that point. Although the big tech names, they were up in the green the whole time.
Yeah, it was interesting, though, because we had similar price action on Friday where we were in the red, and then a lot of people, I guess, decided, hey, there's value out there to be found here. It wasn't a strong bid, but I think a lot of people are trying to kind of figure out kind of the macro.
Yeah.
And if that sorts itself out, then I guess the corporate fundamentals.
Good luck with that, because we have the jobs report on Friday, then we have the FOMC next week. There's a dearth of Fed speak for this week because they're in a media blackout. In the meantime, everyone's succeeding.
Are you missing it?
Oh, no.
You were gone all last week. Did you miss all the Fed speak?
I did not miss the Fed speak.
Okay. All right.
I don't think I ever missed Fed speak. This is the close on Bloomberg. The growth of private credit has seemed unstoppable, but we're now learning more about an ugly moment for Wall Street's hottest trade. Joining us now with some details is Bloomberg's Carmen Arroyo. So this is a story that got a lot of attention because private credit is what everyone is pushing for and talking up right now. But there's an instance where it seems like higher rates is creating circumstances that have led to perhaps not mistakes being made, but private credit one-offs or maybe blow-ups that could start setting a precedent. Talk us through what's going on here. What's the backdrop?
Sure. So as you were saying, private credit has largely been much safer. They've touted it as like, it's just a few lenders. The documents are much tighter than the public markets. Nothing's going to happen. And right now there's a situation going on where a company was kind of underperforming. They had to meet like an interest payment. And when they couldn't, basically the company took some assets away from the lenders and put it in a separate subsidiary and raised new financing.
We're talking about plural sites.
Correct.
And this was a big issue, right? I mean, like, this isn't necessarily unusual, but it's more usual outside of the world of private capital. And I'm curious, is this just kind of that inflection point? I mean, private capital has matured. I mean, it's a behemoth. We know private equity is a behemoth. Private credit has become a behemoth. Wasn't this just kind of the natural evolution?
That's a lot of people are worried about that, actually.
Yeah.
It's become something really, really common in the public markets, but we haven't really seen it in the private markets until now. And it's interesting because it's coming at a moment where there's a lot of funds deploying a lot of cash because they've raised it over the past few years. So,
but it gets to a broader question, too, about the demands that I think some investors are now making on some of these firms. The idea that maybe some of the promises they had for returns in the last vintages haven't necessarily arisen. For the companies themselves, they're saying that they're not necessarily getting the same exit strategies that they were promised. So I don't know, is that forcing some of these people to get creative?
I'm sure. I mean, it definitely is. Like right now, we're in an environment where there's not that many IPOs or M&A as there were back in 2021, and that's like you have to refinance the debt or you have to basically service it. And we're in a situation where a lot of companies are not able to do it in the public markets, and we just don't have that visibility in the private markets. But it's a similar situation, so it's safe to assume the same thing is happening.
We know that higher rates is making it more difficult for a lot of companies to service their debt, but at the same time, a lot of lenders have a lot of money that they need to put to work. That is creating situations where they're starting to not chase deals, but perhaps loosen up on a lot of the concerns or the restrictions that they might have put in place. Talk us through that backdrop.
Sure. So right now, as you said, like the credit markets are very hot, both public and private, and there's not a lot of companies looking to borrow just because there's not a lot of LBOs out there. There's not a lot of M&A. So lenders are just like being a lot more flexible with the terms they're offering. A lot of the deals have like very loose covenants, and they're just cutting pricing a lot. So spreads have gone down a lot. And that's kind of like a concern. And some lenders were kind of like waiting for an inflection point, something like this, to kind of be like, okay, like maybe now documents have to get tighter.
Right. When you published your article, I'm just curious what the feedback was from those in private credit. What did they say to you?
I think there's just a lot of concern if there's going to be similar moves going forward in this space. To be sure, like all the documents are still better in private credit than in the broadly syndicated market. But this is just like, it seems like it's a turning point, or maybe it's just a one-off. We don't know yet, but a lot of people are concerned about it.
All right, Carmen. Well, you and your team, you've been doing some great reporting on this, really, the last few weeks here. And I take it this is probably going to be a story for weeks, if not months or years to come. Carmen Arroyo, a Bloomberg reporter here. Great story on the terminal today, seeing private credit, Wall Street's hottest trade, having a bit of an ugly moment. All right, as we start to wrap up our coverage here on The Close on this Monday afternoon, we're going to set you up for all the things that investors will need to watch over the next 24 hours. That's coming up after the break. This is Bloomberg. All right, welcome back to The Close here. We are pushing ahead here for what markets will have their eyes on here over the next 24 hours. And do you remember, Scarlett, maybe like 2 months ago when India decided to have an election? Well, guess what? We're finally going to get the results.
And we already know what the results are going to be, right? I mean, Narendra Modi is going to win a decisive majority for the third straight time. The rupee is stronger in U.S. trading. This is pretty much priced in.
All right, well, it'll be interesting to see. Maybe we get another reaction like Mexico where everyone knew the outcome, but if maybe the complexion of it is a little bit more dramatic, that could change things. We're actually having a Berlin Aviation Summit tomorrow as well, and I believe Guy Johnson is going to have a sit-down with the man of the hour, and that's the CEO of Boeing, outgoing CEO.
Yeah, that's a good point. The outgoing CEO.
Yeah.
So a lot of questions certainly on who's likely to succeed him and what they're going to focus on under the new regime.
We get some economic data back here in the U.S. tomorrow as well.
Yeah, the JOLTS data is, of course, the one that I'm watching. It's part of the drumbeat to the main attraction, which is the NFP report on Friday.
We have factory orders and durable goods as well. We also get some earnings. Earnings never stop, Scarlett Fu. Before the bell, we start off with, I guess, what used to be a favorite, Bath & Body Works?
Yeah, but I mean, maybe people are still buying scented soap. It's affordable luxury in this day and age when everything's expensive. After the bell, we've got some more enterprise software companies like CrowdStrike.
And HPE as well. And on Capitol Hill, Janet Yellen, the Treasury Secretary, going to be making a stop there for a hearing, as well as the Attorney General, Merrick Garland.
Yeah, so we'll keep you posted on any of those developments. They all begin around, Garland starts reporting at 10 a.m. and Yellen speaks at 2:30.
All right, maybe the folks at Balance of Power will have a little bit more on that. That's coming up at the top of the hour. We'll be back tomorrow on The Close.